Is live. So good to have you on. My name is May Duldalau. Welcome. And today's live is going to be on chapters 12 and 13 of The Intelligent Investor by Benjamin Graham. And we're going to talk about per share earnings in chapter 12 and a comparison of 4 listed companies in chapter 13. My blog is yesfinanciallyfree.com. So go there, put your first name and your email address on the right side if you haven't done so already to get on my email list. And I email out to the list when I'll be live, what I'll be talking about. Now, the schedule for this next few weeks is that I'm reading a chapter of this book, The Intelligent Investor by Benjamin Graham. I'm reading a chapter of this book every weekday at 8:30 a.m. I'm 10 minutes late today, sorry, but every weekday at 8:30 a.m. Hawaii time and at 12:30 p.m. Pacific time until we read the entire book. And this is the first time I've ever read the book too. This book is highly recommended by Warren Buffett because this is Warren Buffett's teacher. Benjamin Graham has passed away, but he is the teacher for Warren Buffett. And Warren Buffett is a very successful investor. Now, there's other people he's taught too, besides Warren Buffett. He's taught many investors over the years. But Warren Buffett highly recommends what he says. So that's why I'm reading it. The stock market did tank a lot, right? In March. It fell 50%. I heard it's recovered 50%. That was as of Monday, which means it's down 25%, right? So if you had 100,000, it's worth 75,000. So that's a big difference, yeah. So the market is considered, maybe it's considered down. How do we know? Well, he teaches us tools to figure out if it's still overpriced or not and whether we should buy. They say that it's a good time to buy. Selectivity in the market might be more profitable, but if we don't know how to figure out which stocks to buy, it's really more like gambling. So that's why I'm reading this book. According to Ray Dalio, the market is going to be down for 3 years. So we might have another stock market tank. The real estate market might crash because, hey, how many people are out of jobs and not have any money to pay their rent except for stimulus money? And the government's printing money. And, you know, if the COVID doesn't, get a vaccine right away, what's going to happen? I mean, So he says it's going to last 2 to 3 years. Ray Dalio is a pretty smart guy. I saw a video done 2 years ago that predicted that we would have a correction now, and no, it's more than just a correction. It's like he calls it pretty much like a depression. So if that's really the case, then the market is going to go down more. But so we have time to learn. We have time to learn how to pick stocks properly without jumping in right now. We have time to learn the techniques and practice them, because it's only going to take a month to read this whole book, guys. It's not going to take a year, okay? And then there's another book by Ben Graham I'm going to do next, which is Security Analysis. So we're going to hit all the basics from Benjamin Graham. And if you guys have more suggestions for me, let me know. I read a book a month. Security Analysis is a huge book. It was kind of scary. So I started with this one. Anyway, this book is written in 1972, but a lot of the stuff he says is still valid today. Some of it is dated, like the tax advice. I don't know how useful that is anymore because tax law keeps changing, but certain basic principles are the same. Okay, so I like this book and I'm going to continue reading it. So thank you for being on the live. And we're going to read chapters 12 and 13 today. If you don't know about me, I'm going to tell you who I am. All right, so I have this blog, yesfinanciallyfree.com. And as you know, my name is May Duldalau. And I used to be really bad with money. Okay, I used to be really bad. I had a lot more debt than my assets. So I had a net worth that was negative 30,000 or something. My debts were as high as negative 41,000 or so back in 2011. It was like $41,000 my debt. And at the time, things were not going well. Okay. And I know a lot of you might be feeling that way now. I know one of my friends is going through bankruptcy right now, personal bankruptcy. And I did not declare bankruptcy, but I had a lot of debt. Yeah. And I didn't know how to get out of it. It seemed like it would never end. Right. So I did certain strategies. I learned principles and I just followed them, like kind of like blind faith. Because what I was doing wasn't working, right? I had all that debt. It wasn't working. So I started following principles. Some of them are real easy that people never do, but they're easy. Like pay yourself first. Before you give money to anybody, pay your rent, pay your bills, you put money aside for you to invest and make you more money. See, I got really good at that. I know a lot of people know that, but don't do it, but I got really good at it. I focused on my net worth. So I would calculate my net worth and chart it. And I focused on my passive income. How can I make more? And I would calculate what it was and put it on a chart. And the reason I did that was because I wanted those numbers to go up. So I did that on a regular basis. And when I did it, and I didn't always do it, after I got married, I took a year off, didn't do it, found out that my net worth didn't change. And then I said, oh, better do it again. So I started doing it again. And then my net worth started going up. It's amazing. It's like magic. But what you track expands. So certain principles I started doing. Long story short, in April of 2016, my debt was all paid off. In December of 2016, we had improved our net worth by $500,000, and our passive income was almost $500 a month, every month. It was mostly dividend income. And I quit my job. I quit my banking job. I was an assistant. That was a nice bank, but I didn't want to work there anymore because I wanted to be a full-time mother. And I pulled my son out of school later in 2017, and I kept him at home while he was 4. And the main reason I did that was because he kept getting sick. Yeah, he would get sick for like 2 weeks every month, 1 to 2 weeks every month he was sick. And then every other month I'd have to give him antibiotics. And I thought, this is not the way to raise a child. So I took him out of school and he didn't get sick for a whole year. A whole year, no sickness. That's just very interesting because now we're having the COVID pandemic. And it's like schools you really do catch a lot of illness in schools. I don't know. So I put him in a new school the next year when he was 5, and he only got sick. Maybe he got like kind of like a drippy nose kind of sick for a while, but that wasn't a big deal. But then he got like only really sick. He got the flu in June, and that was kind of scary, but he got over it. And so only got really sick one time. So I don't know if it's because he's older or the school was cleaner, but I interviewed all these schools and I'm like, I was like, what do you do if a kid's sick? Do you let them come to school? And this was the only school that said, no, they cannot come to school if they're coughing or if they have a fever. And I was like, wow, it's the only school that said that. So this whole COVID thing, I completely get it. They really should not let kids go to school when they're sick. Now, of course, there are economic consequences. What are the parents, if they're both working, how can they take care of the kid if they're sick? Can they even have a job? So there's a lot of complications, but we need to give people time to get better from being sick and not have them in a place where they're exposing other kids and their coworkers to being sick. I had the same thing happen. So for me, when I quit my job, I got healthier, right? Because I didn't have to go to this job, get over stress, plus be exposed to other people's illnesses. I don't know. I got more sleep. That's probably the biggest thing is I got more sleep. So the month before I took my son out of school, we had almost $600, I think it was about $600 in medical copays, just paying, like, our insurance covered most of it, but we had to pay copayments, right? So, antibiotics or whatever, drugs, and it was for me, my husband, and my son, because we were all getting sick. And that was in the summer, which was even crazier, right? It was like, because I took him out of school at the end of summer school. So it was like, I took him out in August, I think it was, or something. Anyway, after that month of $600 in copays, we didn't pay copays anymore because we didn't get sick anymore. Took my son out of school and we all didn't get sick. It was amazing. I got more sleep. My son got more sleep. My husband didn't get sick anymore because we weren't getting sick. Everybody was healthier. So not only did we save $600 a month in co-payments, medical co-payments, we were healthier, happier, getting more sleep. So my life changed on a dramatic level. First of all, I got to do what I love, be a full-time mommy. I started coaching people, Finance Freedom Mastermind trainings, right? I started doing that right when I decided to quit my job. I started coaching my first group. That was in 2016. And then we went on a month of vacation in 2017. We visited family in LA, Canada, Toronto. We went to Niagara Falls, Washington, D.C. We went on a 1-week cruise to Mexico. I'd never gone to Mexico and I'd never been on a cruise. So it was like 2 things I'd never done in my life. It was super fun. And in 2017, we bought our first property together. First time I had ever bought property. Condo in Waikiki. Right? We later sold that. We later converted that one into an Airbnb business, sold it to one of our mastermind members, and used that money to buy this condo, which is also in Waikiki. It's a bigger condo in a better location. It's a nicer building. We're upgrading our lifestyle, yeah. 2018, we bought our second condo, which is an Airbnb business. Of course, it is COVID time, so it's got less business, but numerically enough, it still has business because we have people who are coming here to work who are booking it, so we have some business. Yeah, so we own 2 properties in Waikiki, and yeah, so the point of that whole story is to tell you that if you are really bad with money, and I was really bad with money around the last financial crisis, not because of it though, it was just my own habits, but if you're having problems with money, you can fix it. Like this time around, this whole pandemic, we're fine. Like my whole life situation is completely different. I own property. I live in my own place. I have a positive net worth. I have no personal debt at all. Still, ever since I paid it off, I will never have it again. Okay. Except for a mortgage, but that's different because if you're paying the same you would pay in rent to a mortgage, to me, it's like the same because you have to live somewhere, right? Yeah, so that's the difference. You can create more free time. So for me, financial freedom isn't just money, although money is a very important part and you have to make passive income or it's not working, right? So that's part of it. But one of the ways to measure it besides money is how much time do you have free? How much time are you doing what you love? How much time do you have to exercise? How much time do you have to sleep? Okay. And just take care of yourself, self-nurture, like stretch and exercise and get a massage or pedicure, manicure, whatever. How much time do you have to do that? Right. And to me, if it's increasing, if the amount of time you're playing with your children where you're actually enjoying yourself, you've had enough sleep, you're awake, you actually want to play with your children, if that time is increasing every week, if you're going out with your spouse, like I go out with my husband every week. I do. I go out with him every week on a date, right? How many married couples do that? I know very few married couples where they go on dates. So this is important, okay? It's an important part of keeping a marriage alive. You want to talk about staying wealthy, make sure you stay in love and happy with your wife or husband. Because if you get a divorce, that's like one of the worst financial things, not to mention emotional and relationship wise. It's like one of the most devastating things, right? Especially if you have children. So, hey, that's really, so do you have time to nurture your life? And if you find that you have more and more free time to do things that you love and to take care of the people you love and to take care of your own body and be healthy, then you're on the right track and you're going, and you can do that. You can do that on a gradual basis. You don't have to replace your whole salary to see your whole life change dramatically. So that's what my programs are about. I help you do what you need to do to make real progress in your life. And I specialize in working parents because that's what I was and what I am. Now I only work part-time. So I work an hour a day, a weekday. Some days I don't even work an hour because I sleep in. Like yesterday, okay. But today I'm working too, so I guess I'm making up that hour. But I'm working much less at my work than I used to. Now my full-time is with my son, and with COVID, I am the homeschool teacher now. So I spend a lot more time with him than I did last year because he's in kindergarten, but I'm like helping him learn to read and write and working with his teacher. So there's a lot going on now with COVID that is totally this. So I'm very busy as a mother, right? And that is my primary occupation. So I specialize with parents, people who have dependents they want to take care of, but they also want to love and have a nurturing relationship with. They don't want to stress out about money. They want to have money taken care of, and they want more and more free time for themselves and for their families. That's what I specialize in. So if you're interested in financial freedom, if you know someone else who would benefit from this message, there's a lot of free material here. I've been blogging for years. So yes, financiallyfree.com has hundreds and hundreds of blog posts, all about different aspects of financial freedom, whether it's mindset training, overcoming obstacles, how to reverse credit card fees, how to reduce your credit card interest rates, how to calculate the ROI on investment property if you're interested in buying property, how to get dividends from stocks, how to, create a financial freedom plan. There's all kinds of things there. So go to yesfinanciallyfree.com if you haven't. Tell your friends, tell your family about it because it's a free resource. If you put your first name and email address on the right side, you get on the email list, which is also a free resource where I tell you what I'll be doing every week. And it's always beneficial to financial freedom. Okay, I'm a real person living a real life. I'm a mother. I find that my friends remind me that I am one of the few women who actually talk about financial freedom. And so I have a different perspective from maybe other people. I believe in, real freedom, like having more time to do what you love and become healthy and stronger and more spiritual, all kinds of things. Check it out. All right. So let's read the chapters. I'm here to learn. I hope you are too. I am someone who believes in taking action. So I actually do what I say. I had one of my mastermind members say he really likes me because I actually do what I say. Like if I find something useful, I'll do it. And that's the key. You want to be a doer. Just experiment with small amounts of money so you don't get sad if you lose it all. Okay, guys? That's the key. All right. Be able to learn, but learn gradually so that you actually learn and you're not sabotaging yourself, right? That's something that's interesting. It's all about your mentally understanding where you are, but there's so many aspects, but we're just going to read today. All right. So thanks for being on. Like I said, share this with your friends and followers, subscribe to the YouTube channel. If you're on Instagram watching the replay, then just share it. If you can, go to the blog. All right, here we go. Chapter 12. Oh, by the way, before I begin, I've been reading all the chapters. All the chapter readings I've been doing, they're on my blog. I have a blog post where I've been posting all the video replays. So it's all in one blog. Plus, I've been starting to write the summaries there. So in case you want to read it, I haven't finished yet, but by the time you've seen this video, it might be completely done. So just go to the blog. If you want to see a summary written out, go there. And all the videos are there. So if you like to be organized, there it is. Things to consider about per share earnings. This chapter will begin with 2 pieces of advice to the investor that cannot avoid being contradictory in their implications. The first is don't take a single year's earnings seriously. The second is if you do not pay attention to short-term earnings, look out for booby traps. If you do pay attention to short-term earnings, look out for booby traps in the per share figures. If our first warning were followed strictly, the second would be unnecessary. But it is too much to expect that most stockholders can relate all their common stock decisions to the long-term record and the long-term prospects. The quarterly figures, and especially the annual figures, receive major attention in financial circles. And this emphasis can hardly fail to have its impact on the investor's thinking. He may well need some education in this area, for it abounds in misleading possibilities. As this chapter is being written, the earnings report of Aluminum Company of America, Alcoa, for 1970 appears in the Wall Street Journal. The first figures shown are share earnings, 1970. Hi, Mamba Hoya, welcome. Where are you from? Thanks for being on the live. I'm reading chapter 12 from The Intelligent Investor by Benjamin Graham. And if you want to hear my story, just rewind to the beginning. But let me know where you're from. Okay. 1970, the share earnings were $5.20. In 1969, the share earnings were $5.58. They have a little a, like a superscript. The little a superscript at the outset is explained in a footnote to refer to primary earnings before special charges. There is much more footnote material. In fact, it occupies twice as much space as do the basic figures themselves. For the December quarter alone, the earnings per share are given as $1.58 in 1970 against $1.56 in 1969. The investor or speculator interested in Alcoa shares reading those figures might say to himself, not so bad. I know that 1970 was a recession year in aluminum, but the fourth quarter shows a gain over 1969, with earnings at the rate of $6.32 per year. Let me see. The stock is selling at 62. Why, that's less than 10 times earnings. That makes it look pretty cheap, compared with 16 times for international nickel, etc., etc. But if our investor speculator friend had bothered to read all of the material in the footnote, he would have found that instead of one figure of earnings per share for the 1970, there were actually four. Viz., primary earnings were $5.20 in 1970 and $5.58 in 1969. Net income after special charges was $4.32 per share in 1970 and $5.58 per share in 1969. Fully diluted before special charges was $5.01 in 1970 and $5.35 in 1969. Fully diluted after special charges is $4.19 in 1970 and $5.35 in 1969. For the fourth quarter alone, only two figures are given: primary earnings, which are $1.58 for 1970 and $1.56 for 1969. Net income after special charges is 70 cents in 1970 and $1.56 in 1969. What do all these additional earnings mean? Which earnings are true earnings for the year and the December quarter? If the latter should be taken at 70 cents, the net income after special charges, the annual rate would be $2.80 instead of $6.32, and the price 62 would mean 22 times earnings instead of the 10 times we started with. Part of the question as to the true earnings of Alcoa can be answered quite easily. Thank goodness, because this is complicated. The reduction from $5.20 to $5.01 to allow for the effects of dilution is clearly called for. Alcoa has a large bond issue convertible into common stock. To calculate the earning power of the common based on the 1970 results, it must be assumed that the conversion privilege will be exercised if it should prove profitable to the bondholders to do so. The amount involved in the Alcoa picture is relatively small and hardly deserves detailed comment. But in other cases, making allowance for conversion rights and the existence of stock purchase warrants can reduce the apparent earnings by half or more. We shall present examples of a really significant dilution factor below, page 227. The financial services are not always consistent in their allowance for the dilution factor in their reporting and analyses. Let us turn now to the matter of special charges. This figure of 18,800,000 or 88 cents per share deducted in the fourth quarter is not unimportant. Goodness, so that means it's important. Is it to be ignored entirely or fully recognized as an earnings reduction? Or partly recognized and partly ignored? The alert investor might ask himself also, how does it happen that there were a virtual epidemic of such special charges appearing after the close of 1970, but not in previous years? Could there possibly have been some fine Italian hands at work with the accounting, but always, of course, within the limits of permissible? When we look closely, we may find that such losses charged off before they actually occur can be charmed away, as it were, with no unhappy effect on either past or future primary earnings. In some extreme cases, they might be availed of to make subsequent earnings appear nearly twice as large as in reality by a more or less prestigious treatment of the tax credit involved. In dealing with Alcoa's special charges, the first thing to establish is how they arose. The footnotes are specific enough. The deductions came from 4 sources, viz. 1. Management's estimate of the anticipated costs of closing down the manufacturing products division. 2. Ditto for closing down Alcoa's casting company's plants. Ditto for losses in phasing out Alcoa Credit Company. Also, estimated costs of $5.3 million associated with completion of the contract for a curtain wall. All of these items are related to future costs and losses. It is easy to say that they are not a part of the regular operating results of 1970, but if so, where do they belong? Are they so extraordinarily non-recurring as to belong nowhere? A widespread enterprise such as Alcoa, doing a $1.5 billion business annually, must have a lot of divisions, departments, affiliates, and the like. Would it not be normal rather than extraordinary for one or more to prove unprofitable and to require closing down? Similarly, for such things as a contract to build a wall, suppose that any time a company had a loss on any part of its business, it had the bright idea of charging it off as a special item and thus reporting its primary earnings per share so as to include only its profitable contracts and operations, like King Edward VII's sundial that marked only the sunny hours. The reader should note 2 ingenious aspects of Alcoa procedure we have been discussing. The first is that by anticipating future losses, the company escapes the necessity of allocating the losses themselves to an identifiable year. They don't belong in 1970 because they were not actually taken in that year. And they won't be shown in the year when they are actually taken because they have already been provided for. Neat work, but might it not be just a little misleading? The Alcoa footnote says nothing about the future tax saving from those losses. Most other statements of this sort state specifically that only the after-tax effect has been charged off. If the Alcoa figure represents future losses before the related tax credit, then not only will future earnings be freed from the weight of these charges as they are actually incurred, but they will be increased by a tax credit of some 50% thereof. It is difficult to believe that the accounts will be handled that way, but it is a fact that certain companies which have had large losses in the past have been able to report future earnings without charging the normal taxes against them, in that way making up very fine profits appear indeed, based paradoxically enough on their past disgraces. Tax credits resulting from the past year's losses are now being shown separately as special items, but they will enter into future statistics as part of the final net income figure. However, reserve now set up for future losses, if net of expected tax credit, should not create an addition of this sort to the net income of later years. The other ingenious feature is the use by Alcoa and many other companies of the 1970 year end for making these special charge-offs. The stock market took what appeared to be a bloodbath in the first half of 1970. Everyone expected relatively poor results for the year for most companies. Wall Street was now anticipating better results in 1971, 1972, etc. What a nice arrangement then to charge as much as possible to a bad year, which had already been written off mentally and had virtually receded into the past, leaving the way clear for nicely fattened figures in the next few years. Perhaps this is good accounting, good business policy, and good for management stockholder relationships, but we have lingering doubts. The combination of widely, or should we say wildly, diversified operations with the impulse to clean house at the end of 1970 has produced some strange-looking footnotes to the annual reports. The reader may be amused by the following explanation given by a New York Stock Exchange company, which shall remain unnamed, of its special items aggregating $2,357,000, or about a third of the income before charge-offs. Consists of provision for closing Spalding, United Kingdom operations, provision for reorganizing expenses of a division, costs of selling a small baby pants and bib manufacturing company, disposing of part interest in a Spanish car leasing facility, and liquidation of a ski boot operation. That's funny. Years ago, the strong companies used to set up contingency reserves out of the profits of good years to absorb some of the bad effects of depression years to come. That's smart. The underlying idea was to equalize the reporting earnings more or less and to improve the stability factor in the company's record. A worthy motive, it would seem, but the accountants quite rightly objected to the practice as misstating the true earnings. They insisted that each year's results be presented as they were, good or bad, and the stockholders and analysts be allowed to do the averaging or equalizing for themselves. We seem now to be witnessing the opposite phenomena, with everyone charging off as much as possible against forgotten 1970, so as to start 1971 with a slate not only clean, but specially prepared to show pleasing per-share figures in the coming years. It is time to return to our first question. What then were the true earnings of Alcoa in 1970? Yes, what are they? The accurate answer would be the $5.01 per share after dilution, less that part of the 82 cents as special charges that may properly be attributed to occurrences in 1970. But we do not know what that portion is, and hence we cannot properly state the true earnings for the year. The management and the auditors should have given us their best judgment on this point, but they did not do so. And furthermore, the management and the auditors should have provided for the deduction of the balance of these charges from the ordinary earnings of a suitable number of future years, say not more than 5. This evidently they will not do either, since they have already conveniently disposed of the entire sum as a 1970 special charge. The more serious investors take the per-share earnings as published, the more necessary it is for them to be on their guard against accounting factors of one kind and another that may impair the true comparability of the numbers. We have mentioned three sorts of these factors: the use of special charges, which may never be reflected in the per-share earnings, the reduction in the normal income tax deduction by reason of past losses, and the dilution factor implicit in the existence of substantial amounts of convertible securities and warrants. Okay. A fourth item that has had a significant effect on reported earnings in the past is a method of treating depreciation, chiefly as between the straight line and the accelerated schedules. We refrain from details here, but as an example current as we write, let us mention the 1970 report of Trainco. This firm showed an increase of nearly 20% in per-share earnings over 1969, $3.29 versus $2.76, but half of this came from returning to the older straight-line depreciation rates, less burdensome on earnings, and then the accelerated method used the year before. The company will continue to use the accelerated rates on its income tax return, thus deferring income tax payments on the difference. Still, another factor important at times is a choice between charging off research and development costs in the year they are incurred or amortizing them over a period of years. Finally, let us mention the choice between Fifo, first in, first out, and Lifo, last in, first out methods of valuing inventories. An obvious remark here would be that investors should not pay any attention to these accounting variables if the amounts involved are relatively small. But Wall Street being as it is, even items quite minor in themselves can be taken seriously. 2 days before the Alcoa report appeared in the Wall Street Journal, the paper had quite a discussion of the corresponding statement of Dow Chemical. It closed with the observation that many analysts have been troubled by the fact that Dow had included a 21-cent item in regular profits for 1969 instead of treating it as an item of extraordinary income. Why the fuss? Because evidently evaluations of Dow Chemical, involving many millions of dollars in the aggregate, seem to depend on exactly what was the percentage gain for 1969 over 1968. In this case, either 9% or 4.5%. This strikes us as rather absurd. It is very unlikely that small differences involved in 1 year's results could have any bearing on future profits or growth and on a conservative, realistic valuation of the enterprise. Okay, he has a footnote here. The footnote was on where he's talking about dilution and all those factors. He says, our recommended method of dealing with the warrant dilution is discussed below. We prefer to consider the market value of the warrants as an addition to the current market price of the common stock as a whole. Okay. A lot of technical stuff in here. I'm not even sure if I understand what warrants are, but let's continue. By contrast, consider another statement also appearing in January of 1971. This concerned Northwest Industry Inc.'s report for 1970. The company was planning to write off as a special charge not less than $264 million in one fell swoop. Of this, $200 million represents the loss to be taken on the proposed sale of the railroad subsidiary to its employees and the balance a write-down of a recent stock purchase. These sums would work out to a loss of about $35 per share of common before dilution offsets, or twice its then current market price. Here we have something really significant. If the transaction goes through and if the tax laws are not changed, this loss provided for in 1970 will permit Northwest Industries to realize about $400 million in future profits within 5 years from its other diversified interests without paying income tax thereon. What will then be the real earnings of that enterprise? Should they be calculated with or without provision for the nearly 50% in income taxes, which it will not actually have to pay? In our opinion, the proper mode of calculation would be first to consider the indicated earning power on the basis of full income tax liability and to derive some broad idea of the stock's value based on that estimate. To this should be added some bonus figure representing the value per share of the important but temporary tax exemption the company will enjoy. Allowance must be made also for possible large-scale dilution. In this case, actually, the convertible preferred issues and warrants would more than double the outstanding common shares if the privileges were exercised. All this may be confusing and wearisome to our readers. Yes, but it belongs in our story. Corporate accounting is often tricky. Security analysis can be complicated. Stock valuations are really dependable only in exceptional cases. For most investors, it would be probably best to assure themselves that they are getting good value for the prices they pay and let it go at that. Thank goodness, because this is confusing. Use of average earnings. In former times, analysts and investors paid considerable attention to the average earnings over a fairly long period in the past, usually from 7 to 10 years. This mean figure was useful for ironing out the frequent ups and downs of the business cycle, and it was thought to give a better idea of the company's earning power than the results of the latest year alone. One important advantage of such an averaging process is that it will solve the problem of what to do about nearly all the special charges and credits. They should be included in the average earnings. For certainly, most of these losses and gains represent a part of the company's operating history. If we do this for Alcoa, the average earnings for 1961 to 1970, 10 years, would appear as $3.62, and for the 7 years, 1964 to 1970, as $4.62 per share. If such figures are used in conjunction with ratings for growth and stability of earnings during the same period, they could give a really informing picture of the company's past performance. Hi, Kazar. Nice to see you again. Calculation of the past growth rate. It is of prime importance that the growth factor in a company's record be taken adequately into account. Where the growth has been large, the recent earnings will be well above the 7 or 10-year average, and analysts may deem these long-term figures irrelevant. This need not be the case. The earnings can be given in terms of both of the average and the latest figure. We suggest that the growth rate itself be calculated by comparing the average of the last 3 years with corresponding figures 10 years earlier. Where there is a problem of special charges of credits, it may be dealt with on some compromise basis. Note, the following calculation for the growth of Alcoa as against that of Sears Roebuck and the Dow Jones Industrial Average Group as a whole. So he has 12.1 here, table 12.1. So I will show you table 12.1 on YouTube. There it is if you want to screenshot it. And for Instagram, if you want to take a screenshot, go for it. Okay, let's talk about the table. So he has Alcoa, Sears, Roebuck, and Dow Jones Industrial Average. Our average earnings from 1968 to 1970, that would be 3 years, $4.95 for Alcoa, and he has a superscript, 3/5 of special charges of 82 cents in 1970 were deducted here. Okay, so they took out those special charges, 3/5 of them. So they did take out some of those huge special charges. So $4.95. Sears Roebuck was $2.87, and Dow Jones Industrial Average was $55.40. So that's 3 years average. Average earnings from 1958 to 1960. So I guess that's the 10-year. No, sorry. That's not 10 years. That's 3 years. But that's 3 years in the 10 years ago. Okay. $2.08 for Alcoa, $1.23 for Sears, and the Dow Jones Industrial Average was at $31.49. So the growth, so they're taking 3-year average, so 1958, 1959, 1960, that average of those 3 years, and then they're doing 1969, 1968, 1969, and 1970. So they're doing like a decade difference of 3-year averages. So they're figuring out what is the growth between the two. So for Alcoa, it's 141%. For Sears Roebuck, it's 134%. And for the Dow Jones Industrial Average, it's 75%. So the annual growth rate is compounded annual growth rate. For Alcoa is 9%. For Sears Roebuck is 8.7%. For the Dow Jones Industrial Average, it was 5.7%. Comment. These few figures could be made the subject of a long discussion. They probably should, as well as any others, derived by elaborate mathematical treatment, the actual growth of earnings for the long period 1958 to 1970. But how relevant is this figure, generally considered central in common stock valuations, to the case of Alcoa? Its past growth rate was excellent, actually a bit better than that of acclaimed Sears Roebuck, and much higher than that of the Dow Jones Industrial Average Composite. But the market price at the beginning of 1971 seemed to pay no attention to this fine performance. Alcoa sold at only 11.5 times the recent 3-year average, while Sears sold at 27 times, and the Dow itself at 15 plus times. How did this come about? Evidently, Wall Street has fairly pessimistic views about the future course of Alcoa's earnings. In contrast with its past record, surprisingly enough, the high price for Alcoa was made as far back as 1959. In that year, it sold at 116, or 45 times its earnings. This compares with a 1959 adjusted high price of 25.5 for Sears Roebuck, or 20 times its then earnings. Even though Alcoa's profits did show excellent growth thereafter, it is evident that in this case, the future possibilities were greatly overestimated in the market price. It closed 1970 at exactly half of the 1959 high, while Sears tripled its price and the Dow Jones Industrial Average moved up nearly 30%. It should be pointed out that Alcoa's earnings on capital funds had been only average or less, and this may be the decisive factor here. High multipliers have been maintained in the stock market only if the company has maintained better than average profitability. Let us apply at this point to Alcoa the suggestion we made in the previous chapter for a two-part appraisal process. Such an approach might have produced a past performance value for Alcoa of 10% of Dow Jones Industrial Average, or $84 per share relative to the closing price of $840 for the Dow Jones Industrial Average in 1970. On this basis, the shares would have appeared quite attractive at their price of $57.25. To what extent should the senior analyst have marked down the past performance value to allow for adverse developments that he saw in the future? Frankly, we have no idea. Assume he had reason to believe that the 1971 earnings would be as low as $2.50 per share, a large drop from the 1970 figure as against an advance expected for the Dow Jones Industrial Average. Very likely the stock market would take this poor performance quite seriously, but would it really establish the once mighty Aluminum Company of America as a relatively unprofitable enterprise, to be valued at less than its tangible assets behind the shares? In 1971, the price declined from the high of 70 in May to a low of 36 in December against a book value of 55. Alcoa is surely a representative industrial company of huge size, but we think that its price and earnings history is more unusual, even contradictory, than that of most other large enterprises. Yet this instant supports to some degree the doubts we expressed in the last chapter as to the dependability of the appraisal procedure when applied to the typical industrial company. That's nice. The whole chapter was to show that even though you do all the math, you might still be completely wrong. That's great. Okay. Chapter 13, a comparison of 4 listed companies. In this chapter, we should like to present a sample of security analysis and operation. We have selected more or less at random 4 companies which are found successively on the New York Stock Exchange list. These are Eltra Company, that's ELTRA, a merger of Electric Autolite and Mergen-Thaler Linotype Enterprise, Emery Air Freight, a domestic forwarder of air freight, and Emhart Corp., originally a maker of bottling machinery only, but now also in builder's hardware. There are some broad resemblances between the 3 manufacturing firms, but the differences will seem more significant. There should be sufficient variety in the financial and operating data to make the examination of interest. In Table 13.1, we present a summary of what the 4 companies were selling for in the market at the end of 1970, and a few figures on their 1970 operations. We then detail certain key ratios which relate on the one hand to performance and on the other to price. Comment is called for on how various aspects of the performance pattern agree with the relative price pattern. Finally, we shall pass the 4 companies in review, suggesting some comparisons and relationships and evaluating each in terms of the requirements of a conservative common stock investor. The most striking fact about the 4 companies is that the current price to earnings ratios vary much more widely than their operating performance or financial condition. 2 of the enterprises, Eltra and Emhart, were modestly priced at only $9.7 times and 12 times the average earnings for 1968 to 1970, as against a similar figure of 15.5 times for the Dow Jones Industrial Average. The other 2, Emerson and Emery, showed very high multiples of 31.5 and 42.5 times such earnings. There is bound to be some explanation of a difference such as this, and it is found in the superior growth of the favored company's profits in recent years, especially by the freight forwarder. But the growth figures of the other 2 firms were not unsatisfactory, which means they were fine. Well, he has a lot of double negatives, but okay. I'm going to show you some tables. There is 13.1 for the YouTube people if you want to screenshot that. This is the table for the Instagram people of 13.1. Okay. And then we have 13.2. He has another table here, 13.2. If you want to screenshot that, go for it. And if you're on Instagram, if you want to screenshot that table, go ahead. Okay. So for more comprehensive treatment, let us review briefly the chief elements of performance as they appear from our figures. So let's take a look at 13.13.1. I think he said to look at 13.1, right? We'll just take a look. Okay. So he has Ultra, Emerson Electric, Emery Air Freight, and Emhart Corporation. And then he has things on the left, which are a capitalization. And then he has different items under capitalization and the figures on the right for each of the companies. Income items, and then other specifics under income items, and then balance sheet items and the specific things. And he has the numbers listed next to them. And the first one is the price. So he already told us the price of each company. The number of shares, common shares outstanding, and this is all as of the end of 1970, December 31st, 1970. He has the number of common shares outstanding, and for Ultra it was 7,714,000. For Emerson Electric it was 24,844,000, and there's a little superscript, assuming conversion of preferred stock. So they assume you convert all your preferred stock to common shares. Okay, Emery Air Freight has 3,807,000 common shares, and Emhart has 4,932,000 common shares. Okay, market value of the common shares. For Ultra, it's 208,300,000. For Emerson, it's 1,640,000,000. For Emery Air Freight, it's 220 million, and for Emhart Corporation, it's 160 million. Bonds and preferred stock. For Ultra, they have $8 million. For Emerson Electric, they have 42 million, and for Emhart, they have 9,200,000. Emery Air Freight doesn't have any. Total capitalization. For Ultra, it's 216,300,000. For Emerson Electric, it's 1,682,000,000. Emery Air Freight is 220 million, and Emhart Corporation is 169,200,000. And they're basically just adding the market value of the common stock plus the bond and preferred stock to get the total capitalization. So that's what capitalization means. All right. Income items. So what are their sales, right? So their sales for Ultra were $454 million. For Emerson Electric, it was $657 million. For Emery Air Freight, it was $108 million. And for Emhart Company, it was $227 million. What was their net income? The net income was $20,773,000 for Ultra, $54,600,000 for Emerson, $5,679,000 for Emery, and $13,551,000 for Emhart. Earned per share. How much did they earn per share? 1970, $2.70 for Ultra, $2.30 for Emerson Electric, $1.49 for Emery, and $2.75 for Emhart. Earned per share average. So this is average from 1968 to 1970. For Ultra, it was $2.78. Emerson Electric, $2.10. For Emery Air Freight is $1.28, and for Emhart Corporation, $2.81. And the earned per share average from 1963 to 1965. So he's got a bunch of earned per share averages. So 1968 to 1970 is what I just read. Then he has 1963 to 1965. Then he has 1958 to 1960 underneath. Okay? So I'll just give the 3-year periods all the way down so that you have an idea. So I'm going to repeat a little, but for Ultra, it was $2.78, and then it was $1.54 in that middle 3 years, and then 54 cents in the prior 3 years. Emerson was $2.10 the latest 3 years, $1.06 middle 3 years, and 57 cents per share, earned per share average on the prior first 3 years. Okay. For Emery, it was $1.28 for the 3 years, the latest 3 years, 54 cents for the middle, and 17 cents for the earlier 3 years period. Emhart was $2.81, then $2.46, then $1.21 for the earlier 3-year period. Average current dividend for all the stocks, $1.20 for Ultra, $1.16 for Emerson. Emery has $1, and Emhart has $1.20. And then C is the balance sheet items for 1970. The current assets for the company. So balance sheet is net worth. So $205 million Ultra has, and then their current liabilities are $71 million. So their net assets for the common stock is $207 million, and their book value per share is $27.05. Okay. For Emerson Electric, they have $307 million of current assets. Current liabilities are $72 million. Their net assets for common stock are $257 million, and their book value per share is $10.34. And for Emery Air Freight, it's $20,400,000 for their current assets. Their current liabilities are $11,800,000. Their net assets for common stock are $15,200,000, and the book value per share is $3.96. And last, Emhart Corporation has $120 million in current assets. Liabilities are $34,800,000. Net assets for common stock are $133 million. The book value per share is $27.02. It's interesting because you'd think net assets would be the assets minus liabilities, but it's not. So I'm not sure where they get the net assets number for common stock. But anyway. Okay, and in table, so he's going to talk about 13.1, I think. Yeah, he's going to talk about, so I'm going to read on and then we'll look at 13.2 when he talks about it. But profitability. For more comprehensive treatment, let us review briefly the chief elements of performance as they appear from our figures. So number one is profitability. A, all the companies show satisfactory earnings on their book value, but the figures for Emerson and Emery are much higher than for the other two. So their profitability are much higher. Are they? Maybe. Okay. Okay, let's see. A high rate of return on invested capital often goes along with a high annual growth rate in earnings per share. All the companies except Emery showed better earnings on book value in 1969 than in 1961, but the Emery figure was exceptionally large in both years. B, for manufacturing companies, the profit figure per dollar of sales is usually an indication of comparative strength or weakness. We use here the ratio of operating income to sales, as given in Standard & Poor's listed stock reports. Here again, the results are satisfactory for all four companies, with an especially impressive showing by Emerson. The changes between 1961 and 1969 vary considerably among the companies. Number two, stability. This we measure by the maximum decline in per share earnings. In any one of the past 10 years, as against the average of the 3 preceding years, no decline translates into 100% stability, and this was registered by the two popular concerns. But the shrinkage of Ultra and Emhart were quite moderate in the poor year of 1970, amounting to only 8% each by our measurement, against 7% for the Dow Jones Industrial Average. Okay. Growth, number three. The two low multiplier companies show quite satisfactory growth rates, in both cases doing better than the Dow Jones Group. The Ultra figures are especially impressive when set against its low price per earnings ratio. The growth is, of course, more impressive for the high multiplier pair. Number four, financial position. The three manufacturing companies are in sound financial condition, having better than the standard ratio of $2 of current assets for $1 of current liabilities. Emery Air Freight has a lower ratio, but it falls in a different category, and with its fine record, it would have no problem raising needed cash. All the companies have relatively low long-term debt. Dilution note. Emerson Electric has $163 million of market value of low dividend convertible preferred shares outstanding at the end of 1970. In our analysis, we have made allowance for the dilution factor in the usual way by treating the preferred as if converted into common. This decreased recent earnings by about 10 cents per share, or some 4%. Number five, dividends. What really counts in the history of continuance without interruption, the best record is Emhart's, which has not suspended a payment since 1902. Altra's record is very good. Emerson's quite satisfactory. Emery Freight is a newcomer. The variations in payout percentage do not seem especially significant. The current dividend yield is twice as high on the cheap pair as on the dear pair, corresponding to the price-earnings ratio. Ratios. Number 6, price history. The reader should be impressed by the percentage advance shown in the price of all 4 of these issues, as measured from the lowest to the highest points during the past 34 years. In all cases, the low price has been adjusted for subsequent stock splits. Note that for the Dow Jones Industrial Average, the range from low to high was on the order of 11 to 1. For our companies, the spread has varied from only 17 to 1 for Emery Emhart to no less than 528 to 1 for Emery Air Freight. These manifold price advantages are characteristic of most of our older common stock issues, and they proclaim the great opportunities of profit that have existed in the stock markets of the past. But they may indicate also how overdone were the declines in the bear markets before 1950 when the low prices were registered. Both Altra and Emhart sustained price shrinkages of more than 50% in the 1969-1970 price break. Emerson and Emery had serious but less distressing declines. The former rebounded to a new all-time high before the end of 1970, the latter in early 1971. Oh, okay, so he's referring to, I think, the chart, the table 13.2 when he's comparing the companies, because he shows the ratios, the price-earning ratios. At 1970, the price-earnings ratio was 10 times for Altra, 30 times for Emerson Electric, 38.5 times for Emery Air Freight, and Emhart was 11.9 times. So the price per earnings ratios were much higher for the 2 middle companies than the 2 outer companies. And then price earnings in 1978 to 1970 for Altra was 9.7 times, Emerson Electric was 33 times, Emery Air Freight was 45 times, and Emhart was 11.7. The price divided by book value was 1 time for Altra, 6.37 times for Emerson, 14.3 times for Emery, and 1.22 for Emhart. Net sales in 1970, 4.6% for Altra. Emerson Electric had 8.5%. Emery had 5.4%. Emhart had 5.7%. Net per share divided by book value is 10% for Altra, 22.2% for Emerson Electric. Emery Air Freight had 34.5%, and Emhart Corporation had 10.2%. Dividend yield for Altra is 4.45%. For Emerson, it's 1.78%. For Emery Air Freight, is 1.76%. For Emhart Corp, it's 3.65%. Current assets to current liabilities. Altra has 2.9 times assets to liabilities. Emerson has 4.3 times assets to liabilities. Emery Air Freight has 1.7 times assets to liabilities, and Emhart Corp has 3.4 times assets to liabilities. Working capital divided by debt. For Altra, it's very large. They just have very large. For Emerson Electric, it's 5.6. Emery has no debt, and Emhart has 3.4. Earnings growth per share from 1968 to 1970 versus 1963 to 1965. So the latter 3 years to the prior 3 years, their earning growth per share. For Altra, it's 81%. For Emerson Electric, it's 87%. For Emery Air Freight, it's 135%. And for Emhart, it's 14%. Wow, Emery had 135%. And then the 1968 to 1970 versus the 1958 to 1970. So like a decade comparison. Altra is 400% earnings growth per share. Emerson is 250%. Emery, they just say very large. And Emhart, they have 133%. Price record. So the price record low and high from 1936 to 1968 is pretty crazy, actually. So we'll just do the record. Altra, the lowest price they had was $0.75. The highest was 50 3/4. And the low in 1970 was 18.5/8, and the high in 1971 was 29.3. For Emerson, $1 was the lowest price. The highest price ever was 61.5. The low in 1970 was 42.1/8, and the high in 1971 was 78.75. For the low is for Emery Air Freight is 1/8. 1/8, that's really low. Their high is 66. The low in 1970 is 41. The high in 1971 was 72. The price record low for M. Hart Corporation is 3.5/8. The high is 58.25. Low in 1970 is 23.5. And the high in 1971 is 44.3/8. So there's a lot of different price movements there. Okay. General observations on the four companies. Emerson Electric has an enormous total market value, dwarfing the other three companies combined. It is one of our goodwill giants, to be commented on later. A financial analyst blessed or handicapped with a good memory will think of an analogy between Emerson Electric and Zenith Radio. And that would not be reassuring, for Zenith had a brilliant growth record for many years. It too sold in the market for $1.7 billion in 1966, but its profits fell from $43 million in 1968 to only half as much in 1970. And in that year's big sell-off, its price declined to 22.5 against the previous top of 89. High valuations entail high risks. Emery Air Freight must be the most promising of the four companies in terms of future growth. If the price to earnings ratio of nearly 40 times its record reported earnings is to be even partially justified. The past growth, of course, has been most impressive, but these figures may not be so significant for the future if we consider that they started quite small, at only $570,000 of net earnings in 1958. It often proves much more difficult to continue to grow at a high rate after volume and profits have already expanded to big totals. The most surprising aspect of Emery's story is that its earnings and market price continued to grow apace in 1970, which was the worst year in the domestic air passenger industry. This is a remarkable achievement indeed, but it raises the question whether future profits may not be vulnerable to adverse developments. You mean like COVID-19? Sorry. Through increased competition, pressure for new arrangements between forwarders and airliners, etc. An elaborate study might be needed before a sound judgment can be passed on these points, but the conservative investor cannot leave them out of his general reckoning. M. Hart and Ultra. M. Hart has done better in its business than in the stock market over the past 14 years. In 1958, it sold as high as 22 times the current earnings, about the same ratio as for the Dow Jones Industrial Average. Since then, its profits tripled, as against a rise of less than 100% for the Dow, but its closing price in 1970 was only a third above the 1958 high, versus 43% for the Dow. The record of Ultra is somewhat similar. It appears that neither of these companies possesses glamour or sex appeal in the present market, but in all the statistical data, they show up surprisingly well. Their future prospects? We have no sage remarks to make here, but this is what Standard & Poor's had to say about the four companies in 1971. Ultra. Long-term prospects. Certain operations are cyclical, but an established competitive position and diversification are offsetting factors. Emerson Electric. While adequately repriced at 71 on the current outlook, the shares have appeal for the long term. A continued acquisition policy together with a strong position in industrial fields and accelerated international programs suggest further sales and earnings progress. Emery Air Freight. The share appears amply priced at 57 on current prospects, but are well worth holding for the long haul. M. Hart. Although restricted this year by lower capital spending in the glass container industry, earnings should be aided by an improved business environment in 1972. The shares are worth holding at 34. Conclusions. Many financial analysts will find Emerson and Emery more interesting and appealing stocks than the other two, primarily perhaps because of their better market action and secondarily because of their faster recent growth in earnings. Under our principles of conservative investment, the first is not a valid reason for selection. That is something for the speculators to play around with. Okay, so better market action is not a good reason to buy it. The second has validity but within limits. Okay, Okay, the second one is recent growth, faster recent growth. Okay. Can the past growth and the presumably good prospects of Emory Air Freight justify a price more than 60 times its recent earnings? Footnote. In March 1972, Emory sold at 64 times its 1971 earnings. Our answer would be maybe for the person who has made an in-depth study of the possibilities of this company and come up with exceptionally firm and optimistic conclusions, but not for the careful investor who wants to be reasonably sure in advance that he is not committing the typical Wall Street error of overenthusiasm for good performance in earnings and in the stock market. The same cautionary statements seem called for in the case of Emerson Electric, with a special reference to the market's current valuation of over $1 billion for the intangible or earning power factor here. We should add that the electronics industry, once a fair-haired child of the stock market, has in general fallen on disastrous days. Emerson is an outstanding exception, but it will have to continue to be such an exception for the great many years in the future before the 1970 closing price will have been fully justified by its subsequent performance. By contrast, both Ultra at 27 and Emhart at 33 have the earmarks of companies with sufficient value behind their price to constitute reasonably protected investments. Here, the investor can, if he wishes, consider himself basically a part owner of these businesses at a cost corresponding to what the balance sheet shows to be the money invested therein. The rate of earnings on invested capital has long been satisfactory. The stability of profits also, the past growth rate surprisingly so. The two companies will meet our 7 statistical requirements for inclusion in a defensive investor's portfolio. These will be developed in the next chapter, but we summarize them as follows. Number 1, they have adequate size. Number 2, a sufficiently strong financial condition. Number 3, they have continued dividends for at least the past 20 years. Number 4, no earnings deficit in the past 10 years. Number 5, 10-year growth of at least 1/3 in per share earnings. And 6, price of stock is no more than 1.5 times net asset value. Number 7, price is no more than 50 times average earnings of the past 3 years. We make no predictions about the future earnings performance of Ultra or Emhart. In the investor's diversified list of common stocks, there are bound to be some that prove disappointing, and this may be the case for one or both in this pair. But the diversified list itself, based on the above principles of selection, plus whatever other sensible criteria the investor may wish to apply, should perform well enough across the years. At least long experience tells us so. A final observation. An experienced security analyst, even if he accepted our general reasoning on these 4 companies, would have hesitated to recommend that a holder of Emerson or Emory exchange his shares for Ultra or Emhart at the end of 1970, unless the holder understood clearly the philosophy behind the recommendation. There was no reason to expect that in any short period of time the low multiplier duo would outperform the high multipliers. The latter were well thought of in the market and thus had a considerable degree of momentum behind them, which might continue for an indefinite period. The sound basis for preferring Ultra and Emhart to Emerson and Emory would be the client's considered conclusion that he preferred value-type investments to glamour-type investments. Thus, to a substantial extent, common stock investment policy must depend on the attitude of the individual investor. This approach is treated at greater length in our next chapter, which we will read later, maybe tomorrow if I wake up in time. Thank you so much for being here. We read chapters 12 and 13 of The Intelligent Investor by Benjamin Graham, per share earnings, and a comparison of 4 listed companies. My name is May Duldalau. Check out the blog, yesfinanciallyfree.com, if you haven't done so yet. Go there, put your first name, email address on the right side, and share this with your friends and followers. Subscribe to the YouTube channel. Check out the blog for all the videos. Okay, and I am writing a summary of each as I go along as best I can. Jordan is not awake yet, which amazes me, so I might write some summaries now, or I might just wake him up. So have a great day. Thank you for being on the live. I will see you again soon, hopefully tomorrow at 8:30 a.m. Hawaii time. Aloha.